All right, welcome back. As promised, we're going to bring in Tech Trader to talk about the Nasdaq and some of the tech stocks that he likes and where we are in terms of market sentiment. First and foremost, good morning, Tech T. How are you?
Good morning. How are you doing?
I'm doing okay. You and I had a little chit chat yesterday about how you felt we were in kind of an overshoot as far as your individual sentiment measures that you look at. So why don't you talk a little bit about that and where we are today in relation to where you thought we were yesterday?
Sell, sell, sell if you're a short-term trader. That's my current view.
Across the board or just Nasdaq in particular?
Well, if you were tactically buying stuff when it was cheap, kind of anywhere from November 20th through most of December, I think it's probably a pretty good spot. Again, now this is all based on time frame. Now, even though I do a lot of short-term trades sometimes, I'm personally not selling much. But I was in very good position going into the downturn. I had shorts. I had reduced longs. I kind of, as we've talked about, not saying other guys on the platform were not singing similar warnings, but I was probably the most vocal on the dangers of FANG and the extremely high valued stuff. So, but yeah, I think whether it was, you're seeing huge moves, huge percentage moves off of very, very attractive prices. So here's the problem. If you bought, I'll just throw in it. If you bought Micron in mid-November at I'm pulling up a daily chart right now. If you bought Micron in mid-November at $38, no, it's not a good sell, right? Because it's 35 on a stock that's probably going to go back to 50 or something, or whatever. I'm as you know, I've been bullish on Micron sort of since the November lows, and in the at 30 it was ridiculous. But if if you bought some at 31. Maybe it's a good time to shed some. This is a tactical trading idea. Here's where it emanates from. It emanates from a NIMO. This is the McClellan oscillator I've referred to many, many times. There's also a NAMO. The NAMO is officially the oscillator for the Nasdaq, by the way. The NIMO is just more people are aware of it. It's a New York Stock Exchange advanced decline oscillator. And I think I saw like a 114 or a 117 reading this morning. I honestly don't know if I've ever seen it that high. I probably have seen it that high. I just don't remember it, because here's what happens. And I'll try to post this later. Some of these charts don't show up very well on the platform, by the way. But here's the context. So the context is it's a short-term sell. It's a long-term extremely bullish indicator. And I'll just explain this whole thing because it won't take that long. So anytime you get a NIMO, which really NIMO is sort of like, 65 to 75-ish. It is usually kind of like, it can be a short-term sell because it's basically measuring it's an overbought condition. You have to do things a little differently when you come off a massively extreme, and I'm going to call it, I think the selling late last year, and I've said this before, was completely insane. We actually had a bigger correction. The S&P dropped 20% from top to bottom. I think the worst, in 2016 it was 15%. So it was 5% worse correction than 2016, and 2016 was nuts. So whenever you get that low, by the way, that was also almost a historic low NIMO. So whenever you have a low reading that's like, I think minus 115, minus 120, literally was as a lower reading as we saw in 2008. And so then what happens is it's actually much easier for the NIMO to go up because it's advanced decline. So if you string together a bunch of 90% up days, the NIMO just explodes. The number goes from extreme negative to an extreme positive, right? So the question is, okay, so where do we get short-term overbought, which then we have to basically just sort of melt off or cool off for the next leg, right? I think this might be a little early because you got kind of FOMO kicking in. But put it this way, I think right now, here'd be the best way to say it. We're basically one news story away from a NASDAQ down 50, 100 day, or Dow down 250, 500, something. I mean, just when, Roku went, by the way, I should have bought Roku. Roku went from 30 to 44. That's, by the way, folks, that's 50%. So I mean, but basically, most of the small and mid cap stocks in my coverage universe are up anywhere from 15 to 35%. A few are up 40, 50%. So that's if you were able to buy stuff and you're up 15, 25, 35, 40%. I don't know, sell a third, sell half, sell 100, sell all of it. It depends your positioning, how fast you are, how many trades you do, all that kind of stuff. But yeah, I mean, I honestly, I'm not selling anything. I am looking at it though. I'm thinking about it. I did sell some Yeti, YETI, not a greatest trade because I didn't catch it at lows. I think I made 2.5 points on that piece of it. I actually own some of it above where it's trading right now. But on that piece I sold, I did okay. I think it was like 2.5, 3 point gainer. But I'm looking at stuff. I'm looking at paring some stuff back. My view, though, I'm not super aggressively extended or anything, and I don't really own any names that I'm not worried about that can't go 35, 50, or even 150% higher. So I'm willing to kind of, just like I was easily able to gut out the November lows and the December lows, although Christmas Eve kind of sucked. But again, I covered my shorts. I think covered most of my shorts on Christmas Eve, so that was super opportunistic. And then the following trading day, the first hour, I covered my remaining shorts on the 26th. So here's the setup long term. Whenever you've seen a NYMO move 200 plus points from low to high, that is very bullish because you only see that, guess when? Basically when you make a major market low. So you've only see that 08, 09. I think there was occurred one time in 2010. Definitely occurred at the end of near the 2011 lows. Might have occurred in 2013. Definitely occurred in 2016. So in the data available that I have to track the NYMO, it's only occurred like 5 or 6 times. That you get a minus 100 reading that goes to a plus 100 type reading. And again, that's almost exactly what happens off of a major low that turns into a major move higher. So no, by the way, does anybody think we could have a major move higher here? Doubt it. I might be the only one on the planet that thinks we could have.
No, I don't think so.
Okay, there are other people.
I think we could.
Okay, well there. So, but
I just had to call you out that you're not the only one on the planet.
But remember what I said about this? This feels more like 1998 than 11 or 08. To me, that's what the sell-off felt like. Felt like 1998. Doesn't mean we'll go full crazy 99 bubble, but this. I've actually been working some numbers. The total capex spent on 5G will actually be a lot larger than the total capex spent on internet investment in 99. The difference is the internet, the 99 bubble wasn't just fueled by actual fundamental growth, although a lot of companies were posting 40, 50, 60% growth. There was so much promise and hype and what the new world's going to look like. And isn't it interesting that if you gave it 15 years, a lot of the predictions of 1999 fully came true. But it didn't come true in 3 years. It came true in 15 to 18 years, which most of the people who were buying stocks too high, they couldn't hold those stocks for 15 to 18 years to pay off. But anyway, no, this NYMO condition is actually one of the most interesting things I've seen, I think, in the whole time I've been writing for Briefing. Because I haven't seen it. I wasn't writing for you guys in 16. I joined, I think, shortly after that, at the lows in 16 anyway. But no, this NYMO condition, very interesting. Again, I think we're having an echo of the 1998 Nasdaq sort of mini crash. Nasdaq was down 28%, 1998. It was almost the exact same setup. We had really good growth at the time, but the Fed was overdoing it. There were there weren't really trade issues then. There were debt issues. There were, if you remember, that was long-term capital. That was Orange County. Basically, there's an EEM debt scare. And then everybody had a freak out meeting. Greenspan stopped hiking. Here's the only difference. I don't know if the Fed this time is going to actually lower rates. So Greenspan lowered rates in '98. That was a big reason, and I think he did it pretty aggressively. So that was a big reason. That gave us a lot of bull fuel for a short period of time, for another 12 to 18 months. I doubt the Fed is going to lower rates. I also think people are smart enough and have long enough memories to remember what the '99 bubble was. Therefore, it would be harder to get into something like that. Although, again, NVIDIA 300, Amazon 2000, Facebook 230, Apple 240. That was kind of 99-ish, honestly. There were 5, 6, 8 names, maybe 15 names that were sort of 99 type valuations. They weren't there though, by the way. But it was kind of sniffing it. So anyway, I'll stop there. But this NIMO setup, incredibly interesting. Short term, we're overbought, but it's very bullish long term. Long term, probably being 2 quarters plus. I don't know, maybe even shorter than that. But I'm just saying that you just got to work off the short term overbought condition. By the way, it's possible we don't. It's possible we just stay overbought. I have a hard time believing though that will totally be the case, given that we're seeing some earnings issues. It's kind of like I said, I think we're going to have about the same pre-announcements, the same kind of earnings type action we saw last quarter. And there's going to be plenty of reports that the bulls will celebrate over, but there'll also be plenty of reports that the bears will kind of latch onto, just like last quarter. So I have a hard time believing we stayed this overbought through the bulk of earnings season. Put it that way.
All right, so I've got some questions based on some of the things you're talking about, and we'll jump around a little bit. But first, I want to stay on the NIMO, just so listeners can get some context as to what's an extreme low, what's normal, what's an extreme high, what have you, and then how do you define your short-term time frame versus the long-term, where I think you just did, where from a longer-term perspective, when you see a particular setup, it could be 2 quarters or so. What's the short-term time frame that you talk about?
Well, to me, short-term is probably anything sort of intraday to a few days. It's all relative. For me, long-term, I kind of use 3 things: short, intermediate, long-term. Intermediate's probably more in that 2-quarter range. I don't know. Short-term, sort of short-term. To me, short-term isn't a 15-minute trade. I know there's a lot of people that's probably their short-term, is probably 15-minute trade.
Well, that's why I wanted you to define it for people so they can put it in perspective. Right.
It honestly depends. It kind of depends on, a short-term trade might sometimes when the market's moving slow, a short-term trade might be a couple weeks or a few weeks. And when the market's moving fast, the short-term compresses, because price moves are bigger. So, but I don't know. Let's call it hours to days. Hours to days is short term. Intermediate term is probably kind of traditional swing trading of days to weeks. And long term, to me, long term, anything that's kind of multi-quarter. If I'm willing to hold stuff through quarterly earnings reports, that's probably my version of long term. Although, it's probably more like a year. If I tell this all the time, if I can hold something a year and pay long-term capital gains tax rate, I'd much rather do that. It's not easy to do in this day and age, but I don't know. I've done it quite a bit. So I don't know. If I can hold something, put it this way, if I'm going to hold something three quarters, I might as well hold it. I might as well hold it 4 to 5 quarters and get long-term capital gain streaming.
All right, and is this a ticker that you follow this from, the NIMO, like $NYMO?
Yeah, it's NIMO. It's NYMO.
Just $NYMO.
Yeah,
because I wasn't sure how the McClellan oscillator.
That's it. It's there's also NYAD, which is that's another version of it. In fact, I have all these things I've programmed. There's NIMO, there's NAMO, so that's NYMO and AMO. There's NYAD. And there's other people that have different variations of it, but there's cumulative versions of this. There's a summation index called NASI and NICE, NASI, NY. Somebody wants to get into this, they'll get into this. I mean, I've been looking at this stuff for years and years and years. I will say this, most people that look at this information generally don't spend the time to understand it. They just sort of think, oh, NIMO minus 80, I'm buying. Oh, NIMO plus 75, I'm selling. It's much more complex and nuanced than that. There's some guideposts, but it depends on market conditions. I mean, the NIMO, there was times mid last year where a minus 65 NIMO reading was a really good buy, right? Likewise, there are other times though when a minus 65 was on its way to minus 115. So you got to have market feel. I mean, if you're gonna start delving into the depths of Moria on this stuff, you have to combine it with other things, and you have to develop market feel. Because if you start trying to trade on NIMO and you don't have market feel and you don't understand the nuance, it's going to be garbage in and garbage out for a lot of people. So, but yeah, we're here to help people learn, right? Mm-hmm. So NIMO, NAMO, start there. Startcharts.com has a lot of good educational stuff. They have a library on a lot of this stuff. I've been looking at this kind of data for, I don't know, at least 15 years, if not more. And then I do this thing where I created my own sentiment score where I blend a number of these things together. So my sentiment work, I would say, is pretty much on par with, I mean, there's a guy out there, McClellan. He's good. He's taken over the business from his dad. I'm not going to brag too much, but I actually think I read some of this stuff better than he does in a lot of cases. He waits. A lot of times he waits for like confirmation. There's a lot of times I don't really need confirmation if I have an extreme. So I don't know. Different people do different things. Some people like to see the main thing I see with sort of the traditional technicians is they want to see confirmation on top of confirmation. By the time they finally like something, it's too late in an algorithmic world. So a big chunk of the moves already happened. My view is I sort of try to calibrate all the stuff to what are the programs doing? What are they thinking? How can I out-algo the algos? And that's what I try to do, and been pretty effective at it. So, and then I have an advantage. I helped design databases and do big data and analytics and programming. So, I kind of come from that mindset as opposed to kind of a CMT, the stuff, how you measured stuff 20, 30, 40 years ago. I think that, if you're using technicals today, this is just a broader statement. If you're using technicals today, you better be aware of what the computers are looking at. Because if you're using technicals today and you're using signals that worked pre-uptick rule elimination, in a specialist world before algorithmic trading centers were the market makers, your technicals are not going to work very well. That's why, for example, I think 50 and 200-day moving averages is complete hogwash. It's meaningless. There are times they work, but the times they work is basically a term I would call it autocorrelation. People just kind of finding segments or fragments of times when they worked and ignoring all the times that they didn't work. But by the time a stock goes back to a 200-day moving average, I mean, you've missed a huge percentage of the move. I don't know if you've missed 50% of the move. I don't know if you missed 80% of the move. I don't know if you missed 100. But from a low, from a November 20 low, from a Christmas Eve low, if you wait for ROKU to go back to the 200-day moving average, you're missing a hell of a lot of price appreciation. So that's I'll just end the diatribe there. But I think the most important word or term in all that is, again, the computers are on all these data points. They have them programmed in. They use this stuff. So they have figured out, by the way, I hired a team of programmers. I have my own system I created where I blend, something like 17 technical indicators together, and I found the propensity of the ones that work the best together. The algos do that all the time. They do that real time. They're constantly updating that stuff. So, you're not going to out-technical the algos unless you have other ways of applying market feel on top of it. So I think that's probably a good way to say it.
All right. So it's always good to keep obtaining new tools for the toolbox. I think that's a general takeaway. And use your own interpretation and, apply it to what you're currently working on and working with, and apply that to your own market trading structure. And
that's right.
And go
Well,
you know
what I always say? Here's the easiest way to sum it up. Find a repeatable method that works for you, that works in different market environments.
Mm-hmm. All right. So that's our technical take for today. I want to also touch on something else that you said when you spoke on how you're analyzing or getting a read on the particular tech spends, in this case 5G. And I forget that the other one you said just on tech in general, the CapEx spends.
Well, I was trying. So this is just something I've started doing work on. I'm trying to get data on actually how big the CapEx spend was on internet investment, because that was what was everybody spending money on, from 95 to 2000 was getting internet enabled, right? Interestingly, a lot of the internet spend wasn't that expensive. But see, it's all relative. It's hard because you got to look at things, and GDP was way lower then. The tech space was way smaller then. I'm trying to remember what Cisco. I think Cisco was a $500 billion company at the peak of its market cap. By the way, Cisco traded something like 45 to 50 times revenues. So that would be equivalent to, let's say, had Apple traded at maybe Cisco was more of a grower. I don't know. Give me a growth name.
Back then?
No, today. A CRM. Okay, if a CRM got to 45 to 50 times current revenues today, that would be the equivalent of the bubble magnitude that we had. That's the other. And you always be careful about that too. There's a lot of people that want to call things, oh, this is like 99. I've never seen anything like this since 99. Now, I've said stuff like this, but I always qualify it. I always say it's sort of like 99, but it's nothing like 99, the magnitude. Again, CRM was maybe trading, I don't know what they get to, 13, 12, 11 times, something like that. Cisco, an established tech name with already, arguably kind of peak growth rates, got to like 45 times price of sales. I mean, that's an extraordinary number, and we didn't see any valuations anywhere close to that. I don't even know what like an Akamai, ACAM. I don't even know what that that came out on its IPO. I should go back and try to find what the multiple of revenue was on Akamai at their IPO. That ended up being a winner, by the way. That stock ended up surviving and doing okay. But whatever, I think it was a $300 and some stock. Might have gone to 400. You could have bought Akamai for $2 a share in 2002. Suffice to say, it'll never trade the revenue multiple it did. I mean, I don't know if any company will. But yeah. So anyway, what I'm looking at is sort of, okay, so what's the total? And this is all theoretical because there's no way to exactly measure this, because there's 100 different ways you could define 5G. I define 5G not just the few pure plays in 5G, but as I've said, I like the fiber optics companies as 5G plays, because 5G is going to be hugely beneficial to network investment, fiber optic spend, network spend, all that kind of stuff. So it's going to be a very pervasive capex upgrade cycle. That was the one thing about the late 90s, though, is that the whole internet boom was a very pervasive upgrade cycle, because you had to upgrade a lot of things. So while maybe pure internet technology investment wasn't that big, because standing up a company like Yahoo and Google and Alta Vista and stuff wasn't that costly. How many computers had to be bought, that had to be upgraded, that were not internet capable or not T1 modem capable, right? I mean, so you could go on and on and on. So, but it could be kind of a similar cycle. I mean, this 5G, put it this way, the best way to say it is the 5G cycle is not going to be anything like 2G, 3G, and 4G. It's going to be magnitude larger. That's probably a better way to say it, because it's really, really hard to compare things today with something in 99. It's just, for one thing, it's just hard to get the net dollars on a relative basis correct.
All right. But where do you find the information? Like, what's your go-to source if you want to find?
I don't have the best way is to really kind of look at and this is hard to do, because once you start getting past 10 and 20-year-old data, it's tough. But yeah, just a lot of internet research. But I kind of look at like things like, okay, what's the revenue lift for a subset of companies? That's probably the way I like to kind of do it. And you can basically kind of say, okay, so, you know, what's the revenue lift going to be? And again, it's all theoretical, but what's the revenue lift of Qualcomm going to be over a 1, 2, or 3 year time frame, right? What's the revenue lift of SWR? What's the revenue lift of these optical companies going to be? By the way, I mean, Juniper Networks, Cisco, I mean, there's a lot of companies that are going to get a lot of lift from 5G too. A lot of old technology is going to get upgraded. And then you go back, and I'd have to look at, okay, so what's the revenue lift back then of what were very small companies like a JDS Uniphase, like Ciena, like Cisco, things like that. So, you know, you just do the best job you can to make estimates. And there's other people, you know, I kind of try to dig up reports. I actually think we'll start seeing the Wall Street firms start publishing stuff like this in the not too distant future. But yeah, I mean, it's, you know, you just do the best you can. There's no exact science for it. But it's a relatively easy call if you kind of just look at the total dollars of just general tech spending today are magnitudes larger than they were back in the late 90s. So, you know, and then you say, well, geez, how many different subsectors and industries are involved in this? The bottom line, this is kind of a wonky subject. It's hard to exactly define. But, you know, I do my own stuff, and then I sort of compare those notes with industry reports I see from other people. Here's the one thing I don't do. I'm sure you could pay $3,500 or $5,000 or $10,000 reports from certain people. I doubt those things are worth it in most cases, because it's kind of everybody's trading or everybody's comparing relatively broad guesses. But yeah, I'm certainly not going to be out there spending hard-earned money for theoretical research. I can tell you that much.
All right. Let's dive into one of our first, I guess it wasn't earnings, but we did have a guidance update from Skyworks. And I know you've followed this name quite a bit. I think where we are right now, it's probably at a buy the news type thing, where we saw the sell-off coming in with the bad Apple downward guidance and whatnot. So here we are with Skyworks. It's up nicely today. Does this pique your interest at all, Skyworks?
Well, I've been interested in Skyworks. Yeah, it's a name I could easily be long. I mean, it's the stock was cheap at $80. I mean, stock was very, very attractive at 80.
Well, with that said, you gotta like it a lot better at 67 than you do at 80.
No, I do, but I have to have room. I have to be able to say, look, do I want to sell something I have that I like, or do I want to press longs even more? And add to things when, again, it's arguable. I have a huge weighting in tech already. So, but no, I mean, I liked it. I came very close to buying the stock at 62. But I think there'll be time. I don't know if there's a big sense of urgency. I think you're kind of getting a relief rally, and here's why. It's just like you're getting a relief rally in Apple, but I don't think the Apple core is going to be very good. I think it's very likely we've seen something pretty close to the lows on Apple. I do think Apple could maybe go to a lower low. It doesn't have to. It's kind of like somebody asked me, do I think we hit the lows? And yeah, I kind of did. But the best way I could say is like, look, we don't need to go any lower. We've gone plenty low. And I think how I clarified that was, well, even if the indices go lower, I think a lot of stocks have put in lows. And so for what most of us traders care about, that's good enough. So, okay, so let's talk about Skyworks and Apple. So I think Skyworks, and I've said this, I think the suppliers are much better buys than Apple right now through this cycle. I don't think Apple's going to have a 5G solution. So the Skyworks setup is that they don't just supply to Apple. They supply to a lot of other, I don't know what percent I used to. I think Skyworks is roughly 25% concentration Apple, something like that, 20-25%, maybe a little more. I saw somebody post something that they had. I thought somebody posted something like they had 40 or 45% exposure to Apple. I think that's way high. I don't think their net exposure to Apple is nearly that high. Maybe one quarter last year was that high. Or maybe one quarter at the peak of each iPhone selling cycle is that high, but I don't think annual exposure to Apple is that high. The only company I know that's super high exposure to Apple is Cirrus. Cirrus is about anywhere over an annual basis, anywhere from 68 to 75%, I believe, exposed to Apple total revenues. I don't think anybody else is really even close. But anyway, so the setup here is that I'd still rather buy it on a dip. So, and that's my whole, hey, short-term overbought. We've had a nice spike move. I was much more willing to buy into the November dips. I was much more willing to buy into the December declines. And I'm going to be more willing to buy into future declines. There's no reason for me to buy Skyworks up 4% or up, almost 10% off of lows. When, here's what I'm pretty sure I know. I think, okay, so we've seen one pre-announcement from Apple. So we know what the quarter's going to look like, but we don't know what the guide's going to be like. I don't think the guide's going to be that good. We also know that while there's a ton of iPhones that need to be upgraded, I'm not so sure I think people are now going, okay, so maybe now I'm going to wait a little longer, and maybe I'm going to wait to see if they have a 5G enabled device. And what if they don't have a 5G enabled device when all these companies are lighting up 5G networks? So I'm not so sure this Apple iPhone issue. First of all, it's not all China. Secondly, the China is lighting up 5G. There's going to be plenty of Android devices that are 5G enabled. I don't know. I don't think that. Put it this way, the best way to say, I don't think we have to be in a big hurry on most of these names. Now, if I see 60, 62 or lower, I'd probably be more willing to buy at the second go around on Skyworks. As far as Apple, again, I've said this. I don't know if there's really going to be a long trade in Apple. Really for most of this year. And if they don't have a 5G iPhone, I think iPhones, I think then it could be till summer. It could be till the summer of 2020 before Apple sets up as a super good long again. That would be my dream, by the way, because by then, if it underperforms till then, it will be so hated and so maligned, and there'll be so much angst on Apple. It probably truly will be like a 2013 type setup again on Apple. But again, if they don't have a 5G enabled phone, there's already a fair amount of hesitancy for people to upgrade iPhones already. I don't know. I think, you know what I think we're looking at? I think we're looking at a really good Android cycle, which, by the way, Skyworks will benefit from partially. They'll lose some Apple sales, but they could almost gain almost as many Android sales because they supply all the Android makers. So I think for the Avagos, the Skyworks, the Microns, and folks like that, I think the setup's pretty good. Also, that should be okay for the lights and the IIVIs and the 3D sensing folks. They were counting on a lot of 3D sensing sales from Apple, but it's the same thing. They provide the same products to the Android makers. So I think they'll be able to make up a fair chunk of that. And again, by the way, though, this isn't like anybody calling for that like, okay, nobody's buying iPhones. Well, they're still buying them. They're not buying them with sales growth now. So there's a slower upgrade cycle. And I do think Apple could fix this. This might actually force Apple to have a couple 5G enabled devices, because they could easily choose to do that. So this will be very interesting. I think this will probably be one of the most interesting Apple iPhone upgrades that we've had in quite some time, because it's going to be really interesting. Again, is Apple going to take the chance to not have a 5G enabled device in the lineup. To me, that's pretty darn risky. Now they might do it, and they have the financial strength to do it, and then they'll have a monster upgrade cycle in 2020. So the sales they miss, they'll get back some of them, but they're not going to get back all of them. Just like in 2012, they didn't have a large screen device, and actually in 2013 they didn't have a large screen device. Now they had a monster upgrade cycle once they started making large screen devices. But again, did they regain everything that they lost for 2 years? No, it's impossible to do that. So the bottom line, I'm not too worried that Skyworks is going to go to $100 in a straight line. Put it that way. Same thing. I'm not too worried Micron's going to go to 50 or 60 in a straight line. I generally probably like the stocks I have as much, if not more. Again, here's the semis I like. I like Syna, SYNA. They're not that dependent on Apple. I like AMBA. AMBA's not dependent on Apple at all. I like Qualcomm. Qualcomm is not, Apple's not paying them right now. So if that gets settled in their favor, then guess what? Apple has to start paying them. So I kind of like stuff that has, I guess, less of a God, I need Apple sales, or I'm not going to have any growth. So those are the semis I prefer. Skyworks is a great value. I just don't know. I think I can wait. I just don't think I'm going to miss a 50% move in the name. I might miss a 10% move, and I have, but I don't think I'm going to miss a 50% move. And by the way, if Skyworks does go to 100, in the next 6 months, then I'm probably not really worried about anything. Because if for whatever reason Skyworks goes to 100, I'm probably going to have huge gains in stuff that I own. So I think people get too worried, by the way, about missing out on certain things. But maybe it's because they don't have any exposure to the group. But like I say, I'm not too worried. If Skyworks goes nuts, I think I'll have plenty of things that'll do just fine.
All right. So from this will probably be my last one before we jump into listener questions. But as we head into earnings, what is your overall take? Have numbers come in enough so that we can now, has the bar been lowered enough to make this set up to be a good earnings season, or are we still in troubled waters? What's your overall take?
So that's a great question. So the last time we talked was, I don't even know how many hundred of Nasdaq points lower. So it's very relative. It's hey, at Nasdaq 7,500, I think you got to be a lot more cautious on earnings reports. At Nasdaq 63, 6,400, I think you can actually be fairly aggressive because, just look, okay, Skyworks guides down. By the way, the Skyworks guide down was very minor. Very minor. So I think that's the one thing that helped them. You had a stock that was cheap at 80 that went to 60. Then they guided down. They guided down way less than Apple's recent guide down, which makes sense because they're not 100%. They're not 100% controlled back to Apple sales or tied to Apple sales. So that's why the stock is up today, is because the guide down's relatively minor, given all the bad news in the supply chain from everybody else. But as far as the market goes, I would probably like to see, I would like to see, I'd like to see a little correction. I'd like to see people get scared a little bit before we start producing the earnings reports, because we're probably about 200 or 300 Nasdaq points away from where, boy, you better hit that earnings call right, or it could be pretty ugly. It's also going to be relative to a stock price. So we had, like, here's a name I like. I don't own it yet, but I like it. TLND. Okay, same thing. They guided lower, or they pre-announced, I guess, $1 million. Okay, big deal. $1 million. Stock's already cheap. So here'd be a great case. I'm not really worried about this name. So it's really kind of name by name, and I'm also not worried in the general, like the view that I said this the last time we were on the phone. The view that just because Apple pre-announced, and a few other companies have too, like FedEx or a couple. There's going to be this watershed quarter where it's going to usher in, like, you're going to see massive numbers of pre-announcements. I don't. Again, how many companies have pre-announced since Apple? One or two. And guess what? They've basically been Apple. Samsung pre-announced. There's another one interesting. I wonder if most people have forgotten that Samsung's a huge Apple supplier. They're a massive Apple supplier. Not quite as big as they used to be because they used to provide the core chips. They still do in some way, but Apple bought PA Semiconductor a while ago. But the bottom line is, Samsung's they're a huge Apple supplier. So, I haven't seen anybody do that analysis, by the way, like how much of Samsung's miss was actually attributable to Apple. My guess is probably like 50 to 70% of it. And then 30 to 50% of their miss was attributable to sales of their own phones. So anyway, we get all these subjects, by the way, are very complex. You're asking very, very, very layered questions today. So kudos to you. But I think it's report by report. Like a Facebook setup might be relatively good. Stock's only at 104 or 144. At 134 it'd be better. 134 would be an even better setup. I don't think Facebook's going to have a bad report. Probably going to have a report a lot like last quarter. The current quarter is relatively okay. Maybe the guide is not super good. But if the stock's at 134 to 144, how much juice is left to the downside in the thing, right? Now, if Facebook finds a way, I don't think it's going to do this, but if they find a way to get to 175 before they report earnings, that's probably a short. I'd probably short Facebook at 175 pre-print. So we'll just kind of have to see, but I do think there's going to be plenty of good reports too. Like this whole worry that we're going to go into this earnings meltdown, this earnings disaster, I don't really see it. I think, how many companies beat percentage-wise last quarter? Let's say it was 75%. Maybe it's not quite as high last quarter, but I still think we're going to have a lot of companies with relatively good earnings reports. I think almost every one of my cloud companies, every one of them, I think has probably a very good quarter. And even some of the companies I don't like that I'm looking again. I posted that I was starting to sniff around IGV again for shorts because it's bounced 20 points off of lows. Most of the components in that I still think report good, but it's just a matter of, okay, if it's a minorly good report, does that justify a stock that's massively overvalued? So, but Adobe probably has a good report, but does that mean the stock has come down enough yet? Probably not. So there's still going to be plenty of good reports, just like last quarter. There will probably be a few more misses, but see, the misses that's not a new thing. We've seen this will be like the third quarter in a row where fewer companies are beating by as much. Again, that's kind of typical of kind of the waning phases of an earnings cycle. Now we probably go into a cooling cycle for a while. We'll see how cool it gets. I would say at most, though, we're going to probably have another 1 or 2 quarters lull because we started kind of peeling off of growth expectations, 2 quarters ago. So we had, third quarter, we had some slowing earnings numbers. It actually accelerated last quarter. I don't know. This could actually maybe this could be the last quarter. I don't know. I have to kind of see. I'll know more after we get through earnings calls. But to me, it's situational. It's company by company. But again, I bet the story at the end of the quarter is going to be, wow, what was everybody so worried about from December 20th to December 24th? Because, oh wow, look at the earnings growth. Look at how good these earnings reported. What were people smoking at the end of December? And I kind of said the same thing. People were smoking tax loss selling. and they were smoking, the algorithmic trading, front running the flow of the sellers. And I mean, this period will probably be written about in history, that this was a complete puke fest of sellers that literally sold a lot of inventory at really terrible prices. That 3 months, 4 months, 6 months later, again, it'll probably look a lot like that 1998 echo, where people puked up Nasdaq stocks to the tune of 28% correction, and man, did that look bad 6 months later. I think this period's going to be pretty much the same.
I don't know. Maybe it was too much eggnog on Christmas Eve, as opposed to smoking too much. I don't know.
Well, yeah. Pick your poison. There's a lot of states smoking's legal now, so that could be contributing to the relative reduction in intellect in the markets of the last year or two.
Well, maybe so. Then, and I guess you'd want to root for that because it'll give you a more advantage of taking.
Honestly, I like it. I like it. The more the dumber the market gets, the more money we should be able to make. Put it that way.
All right. So, want to hit some listener questions?
Sure.
All right. So, let's see. Where are we going to start here? First, TECHT, what are your thoughts on ZUO?
Still long it. Haven't sold the share. Still like it. All these are going to look the same. Perfect world, perfect hindsight. And if I wanted to absolutely max out my leverage, I could have added to all these. But yeah, I mean, like here's the best way to answer this. This would be like, I would be very surprised if they don't have a quarter very similar to last quarter. Like I would be very surprised if they don't have a nice strong report, very solid guide. By the way, I like how this company manages their reports too. They haven't been one of these companies like a TTD or a Twilio. By the way, I really like, people remember I was long, loved Twilio, was $30 stock. Now I have no idea why people love it and are putting on their 2019 picks of the year list at 90. But ZUO isn't one of these companies that post these massive blowout increases in their guidance and things like that. I think they've been very rational, very good growth trajectory, big TAM. So this be a good question, because this is going to be, I think, a company that produces a pretty typical kind of good, solid beat, minor raise type quarter. I would be very surprised if they were to guide down or something like that. So good name. There's a bunch of these. And again, at $20, I would still say, at $20, even though it's a decent move off of lows, this is right about where the post-IPO lows were on this stock. And I'll remind people that this thing found a way to go to 35. Now, 35 was pretty juicy, meaning it was pretty probably short-term overvalued. It was very short-term overbought. But, this is another company that, hey, guess what? At the same price they were post-IPO, they put in 4 or 5 quarters of good growth. On valuation, this thing's a lot cheaper than it was, because I think they grew at about 40-45%. And, oh, by the way, the stock hasn't gone up. So you have a company that, let's say that the valuation might have been stretched, at the IPO. It's a lot less stretched now after a year of, again, I'm going to say 35-40% growth. May have been higher. But yeah, no, this would be a good one. And again, at $20, to me, this still looks like it's much more price for a miss than a big beat. So, really good question. I think this is going to be a prototypical company of a lot of earnings reports in this kind of space. A PS, a Pivotal. I probably like Pivotal more, by the way, because I just think it has a bigger TAM. There's a bunch of these. All these new IPO Documentum could be like this. Again, there's a bunch of these. A lot of new software IPOs that are very high quality companies. So ZUO is a good one. I'm going to stay long. I could add to this. This is one like a pullback from here, like what I call these check back moves. I'd love to see a check back of, let's say, $1.50, $2. I strongly doubt it's going to retest anything in the 16s, but anything 1750 to 1850, kind of interesting. Little check back move, and that's kind of what I'm expecting a lot of stuff to do. you call it a partial Fibonacci retracement type potential. So we'll see what happens. But nice name. Still have it. Haven't sold it. I wouldn't even think about selling it here. I mean, maybe 26, 27 is kind of my trim level. That I probably would trim it around 27. But until there, I think it's got plenty of room. Not too worried about it.
All right. So I'm not sure if this next question or the next two questions come from the same listener out there. So I'm just going to combine the two because they're about the same topic. So the first part is TECHT, good pickup on Qualcomm yesterday, but has a question. How do you think the Apple lawsuit plays out in your thinking, or the licensing fee side play out in general? What is priced in? What is likely in your view? And then the second part regarding Apple and 5G, how can they have a 5G phone until they settle with Qualcomm? And he adds, Cook made it clear they are not going to settle last night, and it's
okay, I'm going to start with the second part of the question because that's a really good. That's a very astute observation. I mean, they can, because guess what? They could buy 5G components from somebody else and then refuse to pay Qualcomm for the IP, because that's what they've been. I mean, in effect, every phone that Qualcomm or Apple's selling right now, they're doing, and they're not paying Qualcomm for it. So they're using Qualcomm's technology. Again, they had a contract of some kind that I guess that at some point they just decided they're going to quit paying on the contract. So I'm not a lawyer, but the bottom line is at some point they just said, okay, we're not paying you anymore. Well, they'd been paying them for years and years under some existing contract that I guess they just decided, because they're Apple, they can do something that nobody else can do. Right? I mean, to me, I've said this before, I find it far more interesting. Like, it seems that a lot of people try to kind of make Qualcomm out to be the bad guy here. And to me, it's very interesting to me there hasn't been more sort of vitriol and more accusatory type language to Apple on this. Because it would seem to me, if you just kind of decide that you don't want to pay anybody anymore on a prior agreement, that's you're not being a very good economic party, right? Anyway, I could get really. That's part of the reason it makes me less. It makes me a little bit less interested in supporting Apple, being a shareholder in the stock, frankly, right now. I don't like companies. It would appear to me that Apple's exerting a lot of bully type behavior. I don't like that. Now, hey, to a certain degree, shareholders could have the other argument and say, hey, if you're a big company, you should exert your market power and make the most money you can for your shareholders. Yeah, I agree with that to a point. It's a fine line. You do it too much, you're going to alienate everybody, right? So I think generally it's probably better to be a good actor and have a very, very high ethical business standards. And I think that pays dividends to you long term. And in many ways, Apple's been a very good actor. I think they're very good to their consumers. I think on the data privacy front, they're very forthright, and I think they do a lot of good things there. I think that on the health side, they've been very good. They're literally trying to do good things, sort of for the world, right? But sort of like, hey, what's sort of as a business entity? I kind of think one of the best things you can do is honor your contracts. So the fact that they're not honoring a contract, hey, I take issue with that. I mean, like, I wish somebody would ask. I'd love to interview Tim Cook, by the way. I wouldn't rake him in the coals. First thing it is, there have been times it's been my largest position, so I'd thank him for the fact that, hey, Apple literally changed my life for the better a couple times in my life. So I recognize his contribution to that, but I would ask him, hey, what made you feel that it was right to violate contract law and quit paying Qualcomm? I don't think anybody's ever asked him that question. Now, and maybe he could set me straight that maybe they didn't violate U.S. contract law. Kind of seems to me they did. So anyway, to get without getting too far afield here, I do think they could make a 5G-enabled device. They would just choose not to pay Qualcomm, just like they're not paying Qualcomm right now. So I don't really think that would prevent them. It would not have a Qualcomm amplifier in it, right? Or a Qualcomm chip or a Qualcomm modem, whatever you call the device that Qualcomm sells. But again, most of what Qualcomm gets paid on isn't so much the devices, it's the IP that people pay for. So, but yeah, they could make a 5G device, and I guess just choose not to pay for it. Or maybe the reader thinks that, well, they can't make a 5G device until they settle, and maybe they can't. I don't know, but I would assume they could make 5G enabled devices and just not choose to pay Qualcomm, because not paying them right now. So anyway, what was the first part of the question about how? I would put it this way: it was about, okay, Apple's what's the settlement, or is it going to get settled, or how do I think it's going to play out? Honestly, I'm not that worried about it. I think that over time, the issue is going to get resolved. I think by the way, the most people that own Qualcomm today, you know why they own it? Because it's going to get a 10 or 15 or $20 burst if they get the Apple settlement favorable. Blah blah blah. I'm not in Qualcomm for a 10 or 15 point burst. I think Qualcomm is one, again, it could have a mini type NVIDIA type move on 5G, on everything that is 5G, and everything that they're going to do for 5G, and all the revenues that are going to come in from all these different sources. Eventually, Apple's going to have to pay them. So I'm not too worried that will eventually get settled. I don't know. I think they're in trial with the FTC right now. I think we've talked about this. I find it very interesting that the FTC is going after a U.S. company that's arguably one of the most important technology innovators and IP owners in the country. It seems kind of weird. If this was a European Union going after them, or like China had a dispute. By the way, China had a somewhat similar dispute. Qualcomm settled with China. Isn't it interesting that the Chinese companies using Qualcomm technology don't have a problem paying them? but one of the leading U.S. companies isn't paying them. It just seems all very strange to me. Again, it's strong arm tactics. It's bullying, and I think Qualcomm won a massive case back in like '98 or '99. There's a lot of court precedent. Again, you'd have to talk to a lawyer, get a lawyer's opinion on all this, but I don't know if the decisions today can basically overturn prior precedent. I think the last piece of that guy's question was something about the rates, the Qualcomm licensing rates. Again, we'll have to see. We'll see. I know the stock is very cheap on current revenues and current cash flow and all that kind of stuff. I think a lot of bad news is priced in. Is it ever possible to price in every possible contingent of bad news? No, it's not. But I think people are making way too much focus about the current setup, and especially everything that has to do with Apple, and sort of ignoring the next 3, 4, 5 years of sort of what is going to become a big 5G cycle. So again, I'm not in Qualcomm for a settlement pop, and I think that's what a lot of longs are in it for. They're in it for a settlement pop, and hey, if you want to get a settlement pop and sell the stock at 65 or 70, go ahead. I mean, I think you're going to have a lot of people that end up buying the stock 85 or 90 or 100 or 120 in months to come. I really do believe that. I think that you're going to have this is going to be a name that becomes a momentum favorite. Pick a price that's a lot higher than it is today. I could be wrong, but it feels pretty good to me. Like I said, Apple felt really good to me in 2013. I could have been wrong. I wasn't. I have missed a few of these big calls on these big companies before. But here's the other thing I'd say about Qualcomm, and again, I'm extending the time here, but the other reason I like it is I think the margin of safety is really high. In other words, even if all the worst scenarios play out, I don't know if the stock's got that much downside. And I always look at that. So in other words, I'm not just so much worried about, hey, am I going to get paid if I'm right? But I'm worried about, if I'm wrong, how much downside does something have? And I think there's a lot of things, especially in the space I play in, technology. I mean, stocks can move 20, 30% with nothing wrong. So if something goes wrong, you're looking at a 50% haircut, like Pi. I didn't buy Pi anywhere close to the highs. That's Impinge. I mean, I bought Pi relatively cheaply, like in the low 20s. And yeah, I was down 50% on that thing because they had a couple bad quarters. So, the thing I probably like best about Qualcomm is I think the downside's relatively muted. I'd be pretty surprised if we saw the stock, in the 45 to 50 area again. That's the thing I think is the most important. I think you got limited downside. There's lots of catalysts. I mean, I kind of think there's, why would Apple get an incredibly favorable ruling? It would seem to me the weight of the evidence is more on Qualcomm's side than Apple's, but we'll see. We'll see. Again, that's not really part of I don't overly worry about the resolution with Apple. I think there's more upside than downside, but I just don't think that's a central thesis to what's going to be the thing that drives the stock for the next 2, 3, 4, 5 years.
All right, let's hit on a couple more. In fact, that's all I have at the moment. There's nothing specific to this one, but somebody's looking for your thoughts on FireEye.
FireEye is just a weird, tough stock. If you would have told me ahead of last year what the earnings reports that FireEye produced were ahead of time, and said, okay, Sean, I have a crystal ball, and here's exactly what the next 4 quarters are going to be for FireEye. And based on those, where do you think the stock's going to trade? I said, oh man, the thing's minimum 25, 28, maybe as high as mid-30s, based on those reports. Well, look at it, the stock didn't move. I mean, it's just, so sometimes stocks just act incredibly strangely. Now, it's not strange that FireEye dropped, $3 to $4 during the November-December swoon, because pretty much if you're a tech stock and the Nasdaq drops, what was the Nasdaq decline? I have it here. The Nasdaq decline was 24%. So when the Nasdaq drops 24%, most stocks are going to go down 1.5 to 3 times that amount. They kind of went down in line with the Nasdaq. So that's relatively good. The problem is the stock hasn't gone up nearly what it should have based on just good results. So it's just kind of weird. I don't know if it just needs 1 or 2 key institutional sponsors. I don't know if it's finally going to be the weight of good reports, finally gets the stock to break loose. I will say this, I think it might just become a technical trade. I think that another good report or two, if they could finally bust through, this $20 level has just been a bugger, to use a scientific term. But really, it's that 2022. To me, like if you can just get this thing to trade and close above 2250, I mean, there's just not much resistance until like 30 to 35. So I don't know. For some reason, it's just a very odd stock. It hasn't gotten anything out of good reports. It's been very maligned. They've done pretty much everything you could ask of them to do, frankly. And the stock hasn't gotten much out of it. The last thing I'd say is this. The reason I stay in it, even though it's a dull trader, is that I think maybe the time window is pretty limited here. In other words, if the stock doesn't finally release to the upside on its own, they probably just finally get bought. And they're not going to get bought for $22. You'd probably put a 50% premium minimum on it. So let's say the stock's at 20. I think deal price is 28 to 32, something like that. That's not a bad payoff. It's not a great payoff for a stock that you've owned for 2 or 3 years in a market where a lot of other stuff's done better. At the same time, hey, it's going to end up being a lot better than the market, right? If over a 2-3 year period you make 50-60% on the thing, that's a better return than Mr. Market gave you. So, the one good thing, it's been a relatively low risk name. It's not like it's ever been something, at least from 15 or so, it hasn't had much downside at all. So from 20, you've got a little bit of downside, but I really do. I think they just need to get enough institutional sponsorship that the thing breaks this weird stranglehold that it seems to have around $20. So we'll see what happens. I have it. I haven't sold any of it. I don't try to really trade it much. I also haven't really added to it. I think there's just a lot of other stocks that just act better, get more trades. I've moved a lot of money into other things that are cheaper. Like Acacia is a stock. I continue to like Acacia, continue to like to trade it. Even recently had the beautiful little 4 or 5 point bump off of a low, actually 6 points now. So there's just more stocks with more stuff happening for them. But I think from a fundamental perspective, FireEye just keeps getting cheaper and cheaper because the more quarters they produce that are good and the stock doesn't move, it just is really cheap relative to its peers. So, we saw this with what was another. I mean, there's been a bunch of my stocks that have gotten bought out over time, but this one could end up kind of doing the same. I would say in 6 months or less, if it just doesn't move and the reports are still relatively good, it becomes too cheap of a stock for somebody to acquire. There's too much revenues. There's too much potential cash flow. It would be a really, really good bolt-on acquisition for quite a few names. And you do have some very large companies in the security space that don't have much growth. So if you're a Symantec, if you're a Checkpoint Software, or if you're a Microsoft and you want to get into the space, or if you're other companies that want to enter into the space, it'd be a really, really good deal. But I kind of think I think it kind of breaks through. I thought it might have worked last year. Could have been a good year for it, but I think this year maybe it makes up for lost time and kind of does what it should have done last year, frankly. So again, my price target on stock is easily 50% higher, if not more. I think it could trade to low to mid 30s relatively easily. And again, I think 28.32, that'd be my current buyout price. If the stock got to 25 and held it for a while, then I'd probably say you got 50% M&A premium above 25. So that's kind of what I'd like to see it do. By the way, I'd like to see it trade. I'd just like to start see it trading in a bigger range at a higher price, like maybe 18 to 25 or 20 to 27. So it starts getting more volatile. You can start working the range. You can start trading. It's just been so dull. That's the biggest problem. I think it's just sometimes stocks just underperform out of apathy. And I think we've probably hit the point. We've probably been in max apathy on FireEye for like 9 months now.
All right. Just for the listener's sake, I know we just got a question in, and I'm going to ask this one on PFPT, but I won't be able to keep asking questions as they come in. So I'll ask this one, and I'll ask one on Spotify, and then we'll have to check out.
Yeah, I'll keep these up. But Proofpoint, there's a company I haven't written much about yet. I don't even know if I've done a post. So there's a company called Tenable, which is a newer, this is one of these IPOs, again, these beaten IPOs. Tenable was a $40 stock, it's 23 a day. I would definitely go with Tenable over Proofpoint right here now. Proofpoint was a name, it was really on my short list, near highs. I don't think I ever officially shorted this. Might have had a trading short in it. I honestly can't remember. I definitely had talked about Proofpoint as a short, though. I don't really like it here. Here's a great example. Why would you buy Proofpoint when you can buy, let's just take big, higher price stocks, right? Or market leaders. Why would you buy Proofpoint if you can buy Facebook at 144? Or Twitter at 32? Or, again, I could go on and on and on. But the bottom line is, I just don't really like Proofpoint. I don't really think it's come down as much as it should have. I don't know how durable that their growth, their high growth is. It's a pretty expensive stock. There's just tons of stuff I like better. But specifically, this Tenable looks pretty interesting to me. And FireEye trades at just an absolutely massive discount. I think for FireEye to trade at the same value, and again, this is all adjusted for growth. I know Proofpoint grows faster at a faster rate than FireEye, but I think FireEye would have to triple. And I'm not kidding, I think it'd have to triple to be on par with the relative valuation metrics of Proofpoint. Proofpoint's pretty expensive, so I like Tenable better right here. I like FireEye better. I've done very well with CYBR. That would probably be, so if somebody wants kind of a semi-momentum stock that the machines really like, that's a stock that's closer to highs than lows, I'd probably go with CYBR over Proofpoint, something like that. Another stock, actually, I came so close to buying this. In fact, came really close to calls on this was Palo Alto. And I've written positively on Palo Alto a lot of times. Palo Alto was a top 20 list stock of mine. Around 135 when it went up, 80, 90 points. I removed it and replaced it with something else. But I'd rather be in Palo Alto than Proofpoint. So I wouldn't say Proofpoint's a short here, but I just like other stuff better. As far as Spotify, I think readers know I took a long in Spotify. I might have added to it once into the declines. I like Spotify. I think, in fact, there was a note by somebody put out that I'm like, wow, are they reading my stuff? Because their price target on it's almost identical to mine. they basically kind of have a $190 to $200 price target. Mine's 202. They think it could be one of the names. It might have been Goldman, by the way. It might have been one of the names in their coverage universe that has the most upside. I think they said the most upside to price target from current prices. I think they said, in fact, it might have been Goldman. Goldman might have said Spotify and Twitter are their two of their top picks right now based on upside to target. And I agree with that. I think that again, beaten IPOs. I've written about this beaten IPO thesis. Spotify. Here's the difference between Spotify. And I've talked about this. I mean, it might look expensive on the chart. $190. This stock wasn't expensive on valuation metrics. This stock is way cheaper than a lot of other peers with similar growth rates. So I like Spotify. I own it. I plan to stay long. My trim point, I don't know. My trim point's probably like 160. That's probably where I sell half, something like that. So and I'm a willing buyer of it. I mean, you give me a nice dip, you give me a market dip, and Spotify comes down, 3, 4, 5 points. I think this is a name I'm going to start trading quite a bit, actually. I like these high-price stocks that move, 5, 10, 15 points, and they swing a lot, and you can catch these pretty good trades on them. So I might be a bit surprised if I start trading this more. Like even from yesterday. I mean, this thing was under 115 yesterday. It's 121 now. That's a pretty good one-day move. So I might start posting more of those. Again, I don't post that many ultra short-term trades, but if I can really key in a name and get the cadence on it going and start swinging off a lot of good rinse-repeat trades, I might try to do more of that this year. But yeah, no, I like the name. I think 200 is pretty reasonable. Because at 200, it's not, unless they just have a cataclysmic drop-off in growth. At 200, it's not that expensive. So pretty attractive name. So I know I give analysts credit where credit due, and what they said on Spotify, I agree with.
And then the last part of the Spotify question is there any specific market share data that you've come across for this one, Spotify?
I'd have to look. You almost don't really have to pay too much attention to it now because they're kind of crushing the market. I mean, years ago I used to try to maybe glean a little bit more of that when it was when Pandora was a little more relevant. Again, Pandora's basically been taken out of the space. It's effectively now this is a two-horse race between Spotify and Apple Music, and honestly, they're not even close. I mean, Spotify product offering is vastly superior. Again, so not to beat on Apple, because again, I do think Apple's still a very good company. I just don't think it's a good long relative to where I think the stocks can go. But I have a beef. The beef is why buy all the stock back? Why buy all the stock buyback and not do M&A? I mean, Pandora would have been such an easy buy, super cheap buy. Just having and they could have either left at Pandora or they just could have integrated it with Apple Music, and they radically improved their own product instantly, and they have an ad stream that's additive to their total revenues. Again, they could do 15 deals like that. So much better than buying stock. I mean, had Apple been buying companies back over the last 2-3 years, I'd probably likely still be in the stock. It'd still probably be my largest position. But I think Spotify. It's literally like a two-horse race. Spotify versus Apple Music, and I think Spotify's got a way better platform. So I think I'm more now. Now that it's a publicly traded stock, I'm much more interested. I'm going to get my data from the earnings reports and other stuff. I mean, I'm more interested in how they report. I'm more interested in kind of, how are expectations versus the price action of the stock. So I've basically moved to sort of that method on that name.
All right, my friend. I think we're going to wrap it up and put a bow on this one. A lot of good stuff, and the good news is, as far as I know, we have this one recorded. So I know we get a lot of listeners asking after the fact, did we record this? Well, we certainly tried to, and we should post that this afternoon. So as always, good stuff from Tech Trader. Thank you so much, Sean.
Take care. Have a good one.
You too. We'll talk next week.
All right, bye.